We're going to have 4 speakers, and then we'll take questions at the end. If you have any questions that pop into mind while we're talking, please just enter those in the chat box, and then we'll address them at the end. If you want to say who the question's for, please feel free to do that. Otherwise, we'll figure it out. So we're going to be talking about using niche and conventional, creative conventional financing, plus information and updates on 1031 and the Internal Revenue Code 121 to help buyers and homeowners with refinance needs in a declining market. So I'd like to welcome to our lending and 1031 update. We have 4 experts this morning, all local here in Marin County, serving California and beyond. And we're going to answer your questions. We're going to give some slide information, and then I'll leave it to Shanae Mabrie, our first panelist. He's going to be talking about his recent transition to Bank of the West and all their great products. From what I've learned from Shanae, he had good reason to move over. They have incredible programs with some of the best rates I've seen anywhere by far, and offering greater loan to value and accepting greater DTIs with very high loan to values. So take it away, Shanae, dazzle us, and it's all yours.
Well, thank you, Mary Jo, and certainly honored to have everybody here today. Thank you for joining us. If you could roll me to my first slide, I'll be able to get started on this presentation. My name is Shanae Mabrie. I currently work for Bank of the West, division of BNP Paribas. However, that will change in Q1 of 23. BNP will be selling its Bank of the West entity to Bank of Montreal. So it'll be the same program, same ideas, but the name will be BMO instead of Bank of the West. Here's where we are today. So what I want to do is, in making a transition to this lender, it offers it's a portfolio lender that looks at lending in a different way. And I thought to be important to share with our community is that we look at underwriting a loan that says, hey, does the borrower have residual income? They're a good qualified buyer if they have anywhere from $4,000 to $6,000 to $8,000 residual income. And so what does that mean? Well, here is an example. Okay, if you have husband and wife that both make $10,000 a month, total of $20,000, that they will look at and say, you can underwrite a new loan up to $12,000 a month for the principal and interest payment on the new mortgage you borrow, plus property taxes, plus homeowners insurance, and any other credit report debt that shows up. Well, here's a conventional, creative way of looking at this in this example that says a traditional lender in the jumbo category is realistically going to have a hard stop at 43% total debts divided by total income. Simple math tells you 43% of 20 grand a month is 8,600 a month. We're looking at $12,000 a month. Therefore, if you look at this, a customer would qualify for a $1.5 million home if they have a 20% down and a loan amount of 1.2 million under traditional conventional jumbo underwriting guidelines. Bank of the West will look at this differently and say, look, we can actually qualify you for a $2.1 million home with a loan amount of 1.68. Now, I understand there'll be questions on a case-by-case basis. And when I say that 12 grand versus the 20 grand of income, the difference is $8,000. That was what we call residual income. And that allows us to go up to 60% total debts divided by total income. If you're at $6,000 in residual income, then we'll go up to 55% debt to income ratio. And if you're at $4,000 of residual income, we'll go to 50% debt to income. But in this example, you can see we have $600,000 more in purchasing power. On top of that, we're a lender that says, hey, we want to encourage you to have a banking relationship with us. And we'll provide you a menu list that says, if you want to bring more assets over to the bank post-closing, that we'll give you an additional discount on your rate. Okay. So this allows us an opportunity to help your clients get into more of a home. And a large part of that is that I see a bonus coming. There's income we can't underwrite, things along those lines that people say, well, I feel comfortable in making that stretch. Happy to be able to qualify for more. If we go to the next slide, please. This gives us a menu item of different flexible mortgage solutions. As Mary Jo had mentioned earlier, we do have some of the most competitive rates that are available. We do this on an ongoing basis and looking to generate more lending activity. So feel free to give us a shot, and we're happy to give you a quote in the scenario that per your client's needs. But here's a couple things that we're doing. People have a challenge with down payment. We'll look at an 80-10-10 loan, 80% first mortgage, 10% Bank of the West home equity line of credit, second mortgage, and 10% down payment, up to a $2.5 million purchase price. The interest rate on the first mortgage is going to be the same. There's no additional hit to them. So that allows us to say, look, we can lend more for those well-qualified borrowers. We have lower reserves, and we also do exceptions. And I'll talk more about exceptions in a moment. We do have the ability, and you can look through all this, but we can also be in a position that says, if you have a conforming loan amount or you have a high balance conforming loan amount and you want the jumbo guidelines, if you're willing to invest money and bring that over to the bank, we'll able to put you under those guidelines. We'll look at interest-only loans as well. And then in our underserved areas, in specific counties, the Peninsula and Sacramento counties, some of the East Bay, we actually have through March 30th of 23 a lender credit that will give you $10,500 towards your closing costs. And so that's obviously significant as well. So the nice thing about that is that if you have a buyer moving into a specific county, we can just run the information, say it is in a below market served area, and doesn't matter who the borrower is, as long as they qualify, they can get that credit. We can do the next slide, please. I mentioned to you before, we have relationship discounts that say, here's our menu. If you want to move X amount over, now here's the discount off those jumbo rates that we talked about earlier. In most cases, we'll look at an auto pay on your new mortgage with us. That's pretty straightforward, setting up an account and doing an automated payment from the Bank of the West account. And then here are the other assets that you can see total how much of a discount we can give you off those rates. Next slide, please. We talk about exceptions. Not everybody fits in a cookie cutter box. And so we look at the overall window for our borrower and say, does this make sense? Are there extenuating circumstances? Looking at the whole picture, can we help serve our clients? And just this gives you an example. Now, I don't need to go through each and every one of these. You can read through it, but I will make sure to note a couple key acronyms. When you see 5% LTV exception, the guidelines essentially say X% is our guideline, but we gave an additional 5% loan versus value exception to help do that deal. DP is going to be for down payment. DTI is debts versus income. I mentioned earlier that we can go up to 60% debt to income ratio. And we actually, to be honest, can go up to 100% debt to income ratio if the borrower has enough funds to cover the loan amount that they're looking to borrow. So you get to see these different examples here. FICO is obviously your credit score. So asset dissipation, these are all things that we're using in the Make Sense underwriting model to help people get into new homes. We get the next slide, please. I mentioned earlier about the $10,500 lender credit. You'll see here in this flyer that it has specific counties. So please feel free to take a look at that. Should you know a property is going to be in a served market in that area, that we can take a look for you and confirm that, yep, we can get a lender credit for that borrower. So that should be unique as well. Next slide, please. Thank you so much for this opportunity to speak further. This is my contact information. What I'd like to do at this point is introduce Shanae Mabrie. She is a 1031 exchange provider. She is an accommodator, facilitator for all of your investor client needs. Shanae, take it away.
Great. Thank you so much, Sean. Next slide, please. So one of the things that we're going to focus on today during this segment of the presentation is 1031 exchanges, as well as the primary residence exclusion, which refers to Section 121 of the tax code. And so we're going to highlight also how owners of highly appreciated primary residences can also benefit from a 1031 exchange. And so a 1031 exchange allows for owners of any kind of investment or business use property to defer having to pay their capital gains tax by reinvesting into other investment or business use property. And most of these investors are in for the long game, because under current tax law, you can continue exchanging one property to the next and defer the taxes. And under the current tax law, when you pass away, your heirs will receive what's called a stepped-up basis to market value, which just simply means that your heirs don't have to pay back the taxes that had been previously deferred by the prior owner. So it's a really great tool for wealth building and for wealth preservation. Slide. And so again, with the 1031 exchange, it's allowing for you to defer having to pay the capital gains tax on the sale of any kind of investment or business use property, so long as you're reinvesting into other investment or business use property. So you're just deferring those taxes, but again, you can defer essentially through death. Under Section 121 of the tax code, also known as the primary residence exclusion, it says that a taxpayer or a homeowner can shelter up to $250,000 of gain if they're single, or $500,000 of gain if they're married filing jointly, on the sale of a primary residence, so long as they qualify as having lived in that home for 2 of the last 5 years. Now, I want to really highlight that it's $250,000 if you're single. You can have multiple owners on a property. So let's say you have 2 partners who are not legally married, but they're both on title. Both owners would be eligible for that primary residence exclusion. And so again, we're going to talk a little bit more about how we can combine both the primary residence exclusion and 1031 exchange, even on the sale of a single asset. Next slide. So again, when we're thinking about how to qualify a property for a 1031 exchange, it's going to include any kind of investment or business use property that's held for a period of time, which there's not a bright line rule in the tax code that clearly sets out what that holding period time is, but 24 months is generally going to be a safe timeline. And so you're just exchanging that for other investment real property. And like kind is really a broad term, and it can include things such as bare land. You can exchange out of bare land and into a commercial property. You can exchange out of a single family residence and into an office building. So as long as it's going to be held for investment purposes or for use in the trade or business, it can qualify for an exchange. Next slide. And so a few different ways in which we can identify these exchange opportunities, because it's pretty obvious, any kind of investment or business use property would qualify for an exchange, but there are more obscure ways that we can identify these properties. For example, if you have a client that has a vacation rental, where maybe they're renting it out for, I don't know, let's say 11 months out of the year, and then they want to take a month and vacation there in the summer. Well, they can qualify for a 1031 exchange on that vacation rental. Or perhaps you or your client might have a multifamily property. Maybe it's a fourplex and they live in one unit and rent out the other 3 units. All things being equal, 75% of the property would be eligible for a 1031 exchange, and they can defer having to pay the capital gains tax on that portion. And for the 25% of the property in which they're allocating as their primary residence on their tax return, they can apply the primary residence exclusion on that 25% and shelter the gain. We also have situations, especially as a result of the pandemic, it's really shifted the way in which we think and utilize real estate. And a lot of our local owners, property owners decided, it's the pandemic, we're sheltering in place, but maybe my grandchildren or my family lives out of the area. And they wanted to take this opportunity to be closer to them. And so for a lot of these homeowners, they weren't quite ready to sell their Marin County real estate. And so they decided to convert their homes into a rental property, and they've lived elsewhere. Well, these are really going to be the key owners that you want to start to target to encourage them to sell, because now the last use of the property has been for investment. And so it qualifies for a 1031 exchange, but they also qualify as having lived in the property for 2 of the last 5 years, which means that when they go to sell it, they can still apply and benefit from that primary residence exclusion and shelter either $250,000 if they're single owners or $500,000 if they're married filing jointly. Another common thing that we're seeing here are people who have a primary residence and maybe they have a granny unit or an ADU on the property that they're renting out. Maybe they have a full-time tenant in the property, or maybe they're utilizing it for Airbnb. That portion of the property that's being held for investment would be eligible for a 1031 exchange. And again, for the portion of the property in which they occupy, they can apply the primary residence exclusion and shelter up to $500,000 of gain if they're married filing jointly, or $250,000 if they're single. Next slide. And so when you have owners of investment property or highly appreciated properties, there's going to be 4 potential taxes that will be assessed when they go to sell. And so all in, they could be paying anywhere between 25 to 42% in capital gains tax. And if we were just to quantify that and take $100,000 of gain, $25,000 to $42,000 is going to go straight to the government in taxes. So there's a substantial loss in their buying power and their buying ability by just selling a property outright. Next slide. And so some of the different techniques that we're looking at when combining both the primary residence exclusion and 1031 exchange might be in the case where you maybe have a client who has a primary residence, but they also have a home-based business. And in this example, this particular investor, or couple, I should say, bought a property and it was their primary residence, but they've allocated half of it for business use. So they paid about $1 million for the property. Half of it's been written off on their tax return as investment. The other half has been shown as their primary residence. In this case, they're able to structure 50% of the property as a 1031 exchange and shelter the gain. And on the other half, in which they occupy, they're able to apply the primary residence exclusion and shelter $500,000 tax-free, so they're not having to pay any taxes here. So there really is a substantial cost savings, and by structuring the exchange, they're saving somewhere in the area of around $340,000 in taxes. Next slide. And so in this example here, we have a situation where a client had a primary residence that they've now converted to an investment property, and they have rented it for the past 2 years, and now they're considering selling. Well, they have a gross sales price of $2 million. But again, because the last use of the property was a primary residence, they're able to pocket $500,000 tax-free and keep that. They can use that to apply towards a new primary residence. Maybe they are senior clients, and so they want to maybe get a reverse mortgage. And so they've got $500,000 that they can use to apply towards a primary residence. And then they have about $1.5 million lesser closing costs rolling over into a 1031 exchange and being reinvested into another investment property. So this is a really great way in which you can maximize your sales for real estate. Next slide. And so when we're looking at the mechanics of the exchange, we're going to start with our taxpayer. This is going to be the party that owns the investment property that's being sold. They're going to sell and deed that property directly to the buyer. Buyer's going to deposit funds in escrow, who will then in turn release the proceeds to us as qualified intermediary to hold on the taxpayer's behalf. Once a client has located their replacement property and are ready to close, we're going to again deposit the money into escrow on the taxpayer's behalf. Escrow will release the funds to the seller, and the seller will deed the property directly to the exchanging taxpayer. Now, one of the most important components of the exchange that a lot of our investors are having a hard time with is this identification period. Because from the date of closing on the property they're selling, they only have 45 days to identify in writing to us the property or properties that they're intending to buy. And they'll have 180 days from closing on their sale to complete the purchase of what was identified, but they can only identify property within the 45-day period. Once they go beyond the 45 days, they're then locked into whatever was identified, and no changes or substitutions can be made beyond that point for any reason. And so as a result, a lot of our clients are now considering what's called a reverse exchange. And so next slide. With the reverse exchange, this is where the taxpayer intends to acquire replacement property before they complete the sale of the property that they're intending to sell. And the IRS allows them to do this, but they don't allow for the exchanging taxpayer to own both buying and selling properties at the same time. And so as a result, it requires that we as a qualified intermediary create an LLC to hold title to one of the properties involved in the transaction. And very similar to a standard delayed exchange where they sell first and buy second, the taxpayer will have 180 days to complete the reverse exchange. And so you'll see that the timeline very much mirrors a traditional delayed exchange. So from the date in which we acquire title to the property, they will have 45 days to designate in writing to us the property they're intending to sell. And they will have 180 days, again, from the date in which we took title to complete the sale of the property that they're intending to sell, and then to acquire the replacement property from our LLC. Next slide. And so there are several different reasons why a lot of our investors are wanting to utilize a 1031 exchange. And I think the first and most obvious is that it really allows for the investors to acquire that desirable replacement property before having sold their property. And oftentimes when you're working with investors who are considering an exchange, if they're really savvy, they typically will like to start to look for replacement property before they get their property in contract. But as we all know, they tend to find something that they absolutely love and can't live without. And the reverse exchange gives them the option to buy and secure that property without having sold the property they're intending to sell. Or perhaps they're in a situation where there's very little inventory and they have a pressing need to close on that replacement property quickly. Or maybe they were intending to structure a standard exchange where they sell first and buy second, but there's something that occurs throughout that escrow process, and they need to act quickly to close on the replacement property before they close on their sale. So the reverse exchange takes away that pressure, that undue pressure of having to identify property within that 45-day period. And so there are two different methods to a reverse exchange. The first method that we're going to discuss is with our LLC, the qualified intermediary, acquiring title to the property that the exchanger is intending to sell, with the exchanger going directly into title on the replacement property. And now the positive for the exchanger is that they're getting the loan made directly into their name. The downside, however, is that whatever equity they anticipate netting from their sale, that's how much cash they have to be able to come up with out of pocket for the down payment on the replacement property. So for example, if you have a client that's selling for $2 million and they anticipate netting maybe $800,000 in cash or equity from their sale, that's the amount of cash they have to put down on the replacement property. If they only have $600,000 to put down as opposed to the $800,000, they're going to have taxes on the $200,000 difference. The other thing that could be of concern to them is that if we're acquiring title to the property they're selling, then there might be a due on sale clause with their lender on the property that's being sold. Even though we're taking title subject to the existing loan, there might be a due on sale clause that could be triggered through that transfer of ownership from the exchanger to our LLC. Alternatively, we can then evaluate taking title to the replacement property with the exchanger remaining on title to the property that they're intending to sell. Next slide. And so with this strategy, the upside is that they don't have to worry about coming up with the same amount of cash they anticipate netting from their sale. However, if they're getting a conventional loan on a residential purchase, most conventional lenders will take issue with lending to a shell entity with no assets, which is essentially what we would be creating to accommodate the purchase. So alternatively, many of these investors will look to a private money lender to complete the purchase in a reverse exchange, because a private money lender will have much more flexible lending terms and would be agreeable to lending to our shell entity. And so with that, I would like to introduce our next guest speaker, which is Richard Redmond. He's a private money lending expert and consumer bridge loan specialist. So Richard, why don't you go ahead and take it away?
Thank you very much, Shanae. I am going to talk today about consumer bridge loans, kind of the basics on how they're structured and the primary use cases. And a consumer bridge loan allows a buyer to buy a new house before they sell their old house. So for a lot of people, there's a complication when they want to buy a new house because their down payment money is tied up in the old house. They may have investments that they could use to make a down payment, but they'd have to pay capital gains tax if they liquidated those. And so they want to find a way to be able to get into the new house by using the equity in the old house before selling it. And that's what the bridge loan does, and it does it really well. The primary use cases, and we're still in a market, even though the real estate market has slowed down to some degree. There are a lot of great houses that are still getting multiple offers. And a bridge loan allows a buyer to come in quickly. It can be somebody who's hasn't really been looking for a house, is driving around on the weekend. They see their perfect property. They're not really ready to go. And we can use the equity in the old house. They can make an offer that's non-contingent with a quick close, and then they can sell the departing residence in the breach and take care of the loan. So they can come in with no money down because we're using the equity in the old property instead of a cash down payment. There's fairly light documentation. All consumer loans have what's called an ability to repay rule attached. And the consumer bridge loan is the only loan that is an exception to that rule. And this is really important for example, retired borrowers or people who wouldn't be able to qualify for a conventional loan because they can't carry two mortgages at once. The bridge loan lets them buy a new house without having to go through the income qualification process. And this isn't like the crazy kind of lending that we saw before the last financial meltdown, because the reason that the Consumer Financial Protection Bureau lets consumers do this is because they have the equity in the old house. They just haven't been able to access it yet because they haven't sold. And then even though these loans have a very short hold, because borrowers often sell their departing residence within a month or two of buying the new house, there's no prepayment penalty on these loans. So they're a fantastic tool that enable a home buyer to be able to get into a new house without having to liquidate investments and without having to sell their primary residence first. Next slide. So one of the best places where I've seen this loan be really helpful to people is for retired borrowers. Often a retired borrower they might have been in their house for decades. They have a tremendous amount of equity. They may even own the house free and clear. And they absolutely don't want to sell before they buy. And many people don't want to do that. It can be a tremendous inconvenience. You don't know how long it's going to take you to find a replacement property. You don't want to have to put your stuff in storage and rent for an uncertain amount of time. And especially older borrowers, when they've been in the house for a long time, they really have an attachment to it, and they want to have a certain amount of certainty about what they're going to do. And the bridge loan enables them to find a replacement property and then leave the old property, move in, and then sell their old house. And this is a great tool for the real estate agents, because you guys who are in real estate know that when somebody is in their house, especially if they've been in the house a long time, it often doesn't show well. So the bridge loan enables these borrowers to get out of the old house, get into the new house, get the old house cleaned up and staged, and then it can bring top dollar, which can actually kind of pay for the reverse mortgage or for the bridge loan. Next slide. And then the other situation where we see a lot of bridge loans is with multiple offers. So again, even though the market's a little slower, real estate agents know that the hot properties are still very much in demand. And where we see the bridge loan used a lot is literally somebody will have no intention of buying a new house, but they'll find the perfect property. They'll be driving around and they'll see, oh, this is the house that I really want to get. And they're not ready to go with a conventional lender. And the bridge loan lets them move very quickly. It enables any buyer to buy a home without a loan contingency. There's no appraisal required in most situations. People can move quickly, even though their net worth is tied up in the departing residence, because we're able to use that net worth and impute it for a down payment. They can move quickly and buy a new place. Next slide. So bridge loans are expensive for a reason. And this is one of the biggest hesitations that I find as well. There's 1.5, 2 points in fees. The interest rates are high. Why? Well, conventional lenders won't make bridge loans. And the reason they won't is because the loans have such a short hold. Most conventional lenders make their profit on a loan from servicing the loan over a long period of time. So for the bridge loans, we go to private investors, hedge funds, short-term investors, and those investors have to know that they're going to get a reasonable return. And that's why the bridge loans are expensive. But they're only expensive in terms of comparing them to a conventional loan. Again, if you've got somebody who's going to be able to get out of their departing residence and allow it to be cleaned up and staged before it's sold, that increase in value from having the departing residence cleaned up can often result in greater profit for the seller than the bridge loan costs. So then there's a tremendous convenience factor where people, who wants to sell their house not knowing where they're going to go or how long it's going to take them to find a replacement property. So you can do a cost benefit analysis. And somebody can go look at a house and go, this house is going to cost me $1.5 million. If I use a bridge loan, the bridge loan is going to cost me $35,000. If this house was $1,535,000, would I still want to buy it? And the answer often is yes, especially for someone who's been picky. They've been in the market for a long time. They haven't been able to find a house, or it's somebody who's retired. And retirement community properties or retirement type houses, single level houses that really work for people who are older. These houses are hard to find in the neighborhood that people want. And when somebody finds one, they want to be able to move quickly. So the bridge loan is often the only solution for a buyer, and it actually works really, really well. So thank you very much. I'm now going to turn this over to Mary Jo Lafaye, who's going to talk to you about reverse mortgages.
Thank you so much, Sean and Shanae and Richard. That was a lot of very helpful information. So thanks a lot for putting all that together for us. I'm going to talk a little bit about monetizing home equity for various uses related to retirement. I'm a retirement income specialist, a home equity retirement income specialist with Mutual of Omaha. And so my specialty is working with people 55 and over to help them use their home equity to achieve their financial goals throughout retirement. And we're going to talk today about one of our niche financing, and these are age 55 and over for the Home Safe loan and 62 and over for the FHA loan. So we have two different loans that are available today for people nearing retirement or in retirement, baby boomers, however you want to refer to them. We have the FHA insured home equity conversion mortgage, which is referred to as the HECM. And we also have the proprietary Home Safe Jumbo conversion mortgage, which is similar to the HECM and follows all the same federal guidelines, but it has a higher loan amount. So you can get up to $4 million on the Home Safe loan, which is very relevant to the area we live in. And I've actually done quite a few loans in that range on $7, $8, $9 million homes in the Bay Area. So what's new with reverse mortgages? We have a very dynamic industry. The reverse mortgage industry is always changing and being updated. The last few years have just been a boom with refinancing reverse mortgages from one reverse to a new reverse to get more money at a lower interest rate. So the FHA maximum claim amount for 2023 was just announced, and it's going from $970,000 to $1,089,300. And what that means is the average borrower in the Bay Area, most people have a home worth $1 million or more, but they can get about 35 to 70% of their home value with a maximum home value of $1,089,000. So if their home value is $700,000, they'll get a percentage of that. If their home value is $1,200,000, they'll get a percentage of the max claim amount, which is $1,089,000. And that percentage is based on age and the interest rate at the time of application. So the older they are, the bigger percentage they can get. I have a client right now that's 101 and another one that's 103. And then I have clients that are waiting till they turn 55 to apply. So it's a really broad range of people that are looking to use this home equity to create the life they want. So the big news is, regardless of how much they start out with, so even if they only start out with access to say $350,000 as a credit line, that credit line continues to grow every month over the life of the loan, even if home values go down. So a borrower in their 60s who may qualify for a $350,000 credit line may actually be able to borrow $600,000 or $700,000 over time, because that credit line is increasing in value every single month. And that's actually guaranteed by FHA. It's not based on appreciation. It's based on the fact that as they get older, their actuarial age is changing, and so the lenders can lend them more. So what else is new with reverse mortgage? The proprietary Home Safe Jumbo loans are very popular in California. Some proprietary reverse mortgage lenders, you may have read in the news, have exited the market very recently. They had bought some servicing companies, didn't turn out well for them. And so they're gone, and we don't expect them to come back. However, Mutual of Omaha is still going very strong. We're one of the leaders in the reverse mortgage industry, and we continue to be a leader. And we're also bringing back Wild Kingdom, which many of you probably remember Wild Kingdom from your childhood. I do remember watching those shows. It was kind of the highlight of my week, watching someone wrestle alligators, being the city kid that I was. So some of the things I'm going to be talking about shortly here, how to qualify for a reverse mortgage, who qualifies and what properties qualify, why you need to know about these loans, whether you're a realtor, an estate planning attorney, a financial advisor. Most people in the United States today, when they hit retirement or close to retirement, the majority of their wealth, so more than 50% of their wealth, is usually sitting in their home equity. So that's an important asset, and knowing how to use that and how that can be leveraged to create a comfortable retirement is really essential for anyone, even if you're just looking towards retirement. We want to talk about when the loan is due, how heirs are protected, what does non-recourse mean? All reverse mortgages by law are non-recourse, and how can a lender even allow an open-ended loan with no monthly repayment ever? It's kind of a mystery. People think it sounds too good to be true, but it's all very carefully calculated and regulated by HUD and insured by HUD if you're looking at the FHA option. We're also going to be talking about some of the ways that these highly flexible tools can be used to create cash flow, to protect other assets, and to enable older homeowners to thrive through a healthy retirement in a house that they want to live in. So number one, very popular loan today is what we call the FHA's lifestyle loan. And that's just a new form of the home equity conversion mortgage, the FHA reverse mortgage, that allows homeowners to sell a current property and purchase their next home using a reverse mortgage. So the new home would be encumbered by the new loan, which is a reverse mortgage. And the benefit to that is anyone that's downsizing or right sizing. And when I say right sizing, a lot of older people are actually moving up. They're buying more expensive homes. So they need somewhere to access that additional money without taking on a mortgage payment during retirement. So they want to maybe walk to town. They want to buy a home that's really well situated so they can walk places as they get older. Maybe they want to move to a more expensive area than they live in now to be closer to kids and grandkids as they age. Or maybe they want to buy a property that has an accessory dwelling unit so that they can use that for a home office or family coming to visit. Maybe they want to use it for rental income or even for a caregiver's quarters. So these loans all are available for 1 to 4 unit buildings, single family homes up to 4 units, as long as one of the units is occupied by the borrower. So we also have the proprietary HomeSafe jumbo loans. They're federally regulated by FHA, like FHA loans, but they're not federally insured by FHA. So there's no mortgage insurance premium. The lenders do self-insure on these loans. So they're taking a lot of risk by having an open-ended loan with no repayment due as long as the borrowers live in the home. And so their interest rates are a little higher on the jumbo loans. All reverse mortgages are available as a variable interest rate or a fixed interest rate loan, and all can be refinanced after a 12-month seasoning period to take advantage of the next rise in home values. So if someone were to take out a variable rate reverse mortgage today, and a year or two from now, home values went back up and rates went down, they could take advantage of the variable rate and get the lower rate automatically, or they can refinance to get more money later if they qualify at that time. Some of the creative uses for reverse mortgage: the lifestyle loan to purchase a new home. That's the one we just talked about briefly. That allows borrowers to not use all of their cash. So perhaps they're in their 70s and they're selling a $2 or $3 or $4 million home, and they want to take some of that money and put it into their investment accounts to create more income in the future. That way, they don't have to use all of the cash from the sale of their current home to buy their new home. They have some easy financing with no monthly repayment required, allows them to keep cash to invest. These loans all have very minimal income and credit requirements. The borrowers only have to qualify showing enough income to show that they have the willingness and capacity to pay their property charges. So that's property tax, homeowners insurance, flood insurance if they're in a flood zone, and homeowners association dues if they have an HOA. So this can boost their purchasing power by a lot. And a lot of borrowers, older borrowers especially, I find they're considering selling their home, but they're nervous about, where are they going to go next? Are they going to be able to stay local? Are they going to be able to live near friends and their community, or move closer to grandchildren? So being able to give them another, 30 to 60 to 80% to purchase their next home with a loan that's easy to qualify for and requires no monthly repayment can be a pretty important factor in them deciding to downsize or right size. So using these loans, if they're not using it for a purchase, they can also use it as a credit line. They can get it against their current house, or maybe they want to pay cash for their next house and just get a credit line against it. They can automatically qualify for a reverse mortgage credit line just based on age and minimal income and credit requirements. And they can use that to fund anything at any time in the future. There's no requirements or restrictions on how they use that money. They can use this for a buffer asset. That's a very common term that's being used a lot in the financial planning world. So if you're a financial advisor, or you just like to know more about how this integrates with buffer asset planning, I can provide a Wade Fowles recorded webinar on that topic. A lot of people are paying for care. In-home care or a spouse's care facility is a common use for reverse mortgages. You can use these loans to rehabilitate investment properties. So I have clients that may have other homes or buildings that they rent out, and they need money to rehabilitate those so they can keep them occupied and get higher rents, but they don't qualify for conventional lending to get that money. So they can do that through their primary residence. And then paying off bridge loans. Richard was talking about older borrowers wanting to use bridge loans so that they can buy their new home and move in and get comfortable before they put their other home on the market. So I've, in many instances, have helped those same borrowers pay off their bridge loan with a reverse mortgage. So again, they don't have to take on a monthly payment. Some other creative uses of buying multifamily homes to live in one unit and have rental income for the others, paying off a conventional loan so that retirement becomes possible. A lot of people say, they call me and they say, you know, Mary Jo, we'd be comfortable in our current home if we didn't have a mortgage payment. So this can help them achieve that. Helping kids with funds for down payment. If you want to keep your kids and your grandkids nearby, you got to help them get housing. So that's a common use. And then having somewhere to draw money from so that they can lower their draw rate on their investment accounts. So these are kind of the 4 pillars of retirement that advisors are looking to provide for their clients: cash flow, liquidity, longevity, and then legacy, leaving something for the heirs. And these are some of the top ways that people can incorporate their housing wealth into their overall retirement income stream: eliminating a current mortgage, something to pay for investment property care, buy a vacation home. You can get a lifetime monthly payment from a reverse mortgage guaranteed by HUD. Even if you live to 120, still keep getting that monthly payment. Might not buy many eggs by that time, but you can still keep getting it. And you can change how you receive the money at any time. So if you choose a lifetime payment and later want to get a monthly payment of a higher amount, you can do that. And then right sizing, and then of course silver divorce. If you've read anything about the aging population, the only demographic with a rising divorce rate today is people 55 and over, and 1 in 10 people getting divorced today is over 65. So this can help them buy their next home without taking on a monthly payment. So why do reverse mortgages have a bad name? A lot of the information about reverse mortgages is very outdated, and they're referring to the old reverse annuity mortgages, which were very inflexible and enabled the lender to get a portion of the borrower's future appreciation, plus they required an annuity purchase. So those are no longer being done. Those were went away in the 90s. And of course, they kept coming due over time because people were living, 10, 20, 30 years. And then we've had additional improvements since 2015. And every year, HUD is making improvements in the program. So they're actually extremely consumer friendly and growing in popularity. So here are some of the myths. The bank does not own the home. The heirs do not lose their inheritance. Heirs inherit the property, including all the future appreciation on the property, subject to the debt. So just like a conventional loan, the heirs inherit the property or the estate, and they can keep the property through refinancing the debt. They can call Richard or call Sean and figure out how to refinance that loan if they want to keep the home. Or if there's more than one heir, typically they will sell the home, pay off the loan, whether it's a conventional loan or a reverse mortgage, and then divide the rest of the money amongst the heirs. So I included a lot of slides here that we won't go over in quite as much detail as if we had more time. So you can refer back to them later and then call me with any questions you have. So here's back to Shanae's example of someone who was going to sell a $2 million home and use a 1031 and a 131. So sale price, this shows a sale price of $2 million for a borrower with a large $850,000 mortgage. They would pay off their mortgage and pay their sale fees and have net cash left over of around $1.030 million. Let's say they found a new home of $1 million value, but they didn't want to use all of their cash. They want to reserve some of that for their future retirement needs. So we can help them buy that $1 million home with a lifestyle reverse mortgage called a lifestyle loan. And that funds at the purchase of the new home, $354,000 purchase. And this is for someone in their 60s. And then they would pay $646,000 cash down payment out of their $1.030 million. And that would leave them $384,000 to add to their retirement nest egg. So that can be a pretty big shift, getting rid of a huge mortgage payment and adding a lot of money to their investment accounts for future growth. So this is a little bit about who qualifies. You do have to plan to use all or part of the property as a primary residence and be between 55 for the jumbo loans or 62 for the HECM loan. If you have a younger spouse, they can qualify also to be what's called a non-borrowing spouse and have the right to live in the home for the rest of their life with no repayment, but you would get less money based on the youngest borrower's age. So we qualify based on the ability to pay property charges, maintenance, and utilities. We don't have to qualify borrowers for a mortgage payment because there's no mortgage payment due. So that's a huge benefit. The borrower must occupy the property within 60 days of purchase. And again, the estate receives all future appreciation when the loan comes due. And these loans are fully non-recourse, which means the borrower and their estate actually have no responsibility to repay the loan. Only the property is liable for the debt. So if the borrower would end up owing more than the home's value, for instance, if all appreciation stopped and the property never appreciated again, and the debt continued to grow in value, then none of the borrower's other assets would be liable for repayment, only the subject property. The loan is due when the last remaining borrower and the eligible non-borrowing spouse permanently depart the property, meaning they move to assisted living, or they sell the home, or they move out, or they pass away. When the last remaining person leaves the home, that's when the loan is due. And these are the bits of information I need in order to do a loan comparison for a client. So it's pretty basic. You don't have to give me their name if you're, keeping their identity private initially, but I can give you a full loan comparison with just a few pieces of information. So here's my contact information, and now we're going to open it up to questions. Looks like we have 3 questions at the chat box, so we'll address those first, and then we'll find the appropriate person to answer them. And then, of course, we'll all be available and able to answer questions for you anytime in the future if you want to take a deeper dive into any of the areas that we specialize in.
So I'll just jump in. What we have here, I mean, obviously, were some nice comments from folks. Thank you very much. I think that Tanya Patterson had just said, look, and Richard already commented about you have other advantages with multiple offer situations for the private money lending route. So I think that, do we have any other questions? Please feel free to come off mic, and we're all here to serve. Let us know. We explained everything so clearly.
You did. It was wonderful. Thank you.
So I think that's Mary Jo. I mean, it looks like we've addressed questions. We will send this information out to everyone. If you know anyone that has further needs that we can be of service for, that's what we're here for. And anything else, Mary Jo, before we wish everyone happy holidays? You'll have to come off mute, though. Mary Jo, you'll have to come off mute.
Thank you. I said thanks to our presenters and to everyone who registered and those who were able to attend. And we'll get the recording out shortly to everyone. Thank you so much. Happy holidays.
Happy holidays.